U.S. nat gas futures fell about 2% to a two-week low on Friday on forecasts for lower demand next week and expectations power generators will burn less gas after Hurricane Milton knocked out power to millions of homes and businesses in Florida. That would be the first time the contract dropped for 5 straight days since late August. During that time, it was down about 12%. The average gas output in the U.S. fell to 101.2 billion cubic feet per day so far in October, down from 101.8 billion in September. Analysts forecast average gas demand in the U.S., including exports, will rise from 96.4 billion cubic feet per day this week to 96.9 billion next week. Gas flows to the 7 big U.S. LNG export plants declined to an average of 12.4 billion cubic feet per day so far in October, down from 12.7 billion in September. That reduction was primarily due to the planned shutdown of Berkshire Hathaway Energy's 0.8 billion cubic feet per day LNG export plant in Maryland for approximately 3 weeks of annual maintenance, which could conclude as early as October 11. Meanwhile, the gas rig count, an early indicator of future output, is 1 rig down from 102 last week and down from 118 1 year ago. Much of the U.S. will be comfortable with highs of 60s to 80s besides hotter 90s across Texas, as well as cooler 50s over portions of the Great Lakes and Northeast as weather systems sweep through. Overall, natural gas demand is projected to remain low next week. However, the medium and long-term outlooks remain bullish, making the current price dip likely short-lived and potentially a good buying opportunity ahead of winter, which is expected to be much colder than usual. The last 3 winters were unusually warm, raising the odds of a frigid winter this year. If this forecast holds true in November, we could see sustained bullish momentum, with prices pushing toward $3.50 or even higher. WTI crude oil prices rose but failed to break the $76 resistance last week as investors weighed potential supply disruptions from the Middle East conflict and the effects of Hurricane Milton on fuel demand in Florida. Nevertheless, the U.S. benchmark posted its second consecutive weekly gain and has surged over 10% since Iran's missile attack on Israel. The rally has been driven by geopolitical tensions in the Middle East, particularly Israel's potential retaliation to Iran's missile attack, raising concerns about further supply disruptions. Hurricane Milton also contributed to short-term fuel demand in Florida, though long-term consumption could be dampened by the storm's aftermath. On the demand side, the outlook improved after top crude importer China unveiled a draft law to promote private sector growth, aiming to boost investor confidence amid an economic slowdown. Natural gas remains under pressure as traders focus on the consequences of Hurricane Milton, which has led to lower demand. From a daily technical perspective, bulls need to protect the $2.48 support level. If it does occur, there's a likelihood that the market could target the $2.60 level followed by a retest of $2.70 as the next likely target. This range could continue to act as a barrier unless strong bullish momentum emerges. Meanwhile, the 50-week moving average at $2.40 is providing solid support and could be an appealing entry point for buyers positioning ahead of winter. Please like, subscribe, and comment to support the channel. See you in the next one.